Last year, South Korea's pet insurance industry surpassed a major milestone, with total direct premiums written exceeding 100 billion won for the first time. Direct premiums written represent the total premiums insurers collect directly from policyholders. In other words, the pet insurance market has expanded rapidly. Despite this growth, however, Korea's pet insurance enrollment rate remains relatively low. Although pet ownership continues to rise, only a small share of owners choose to purchase insurance for their animals. So, what is preventing more people from signing up for pet insurance? How does insurance work? Insurance is a system in which many people facing similar risks pay premiums in advance, and those funds are used to compensate individuals who actually experience a loss. For example, if someone gets into a car accident, paying the repair costs alone can be a heavy burden. Instead, the cost is shared using the insurance premiums collected from many policyholders. Insurance companies cannot simply decide premium prices without evidence. They need to know how often accidents or illnesses occur and how much they typically cost. Otherwise, premiums could be set too low, causing financial losses for insurers, or too high, discouraging customers from buying insurance. Insurance helps people manage risk, but it is built on data. Not every risk can be insured. Before an insurance product can be offered, insurers must be able to predict how likely the risk is. Why is pet insurance difficult? When people visit hospitals, the cost of the same medical treatment is generally similar because South Korea's national health insurance provides standardized pricing guidelines. Animal hospitals, however, operate differently. Most veterinary clinics determine their own treatment methods, equipment, and pricing. As a result, even pets with the same illness may receive different tests or treatments, leading to significant differences in medical costs. To offer pet insurance, insurers must estimate average treatment costs and the likelihood of different illnesses. But when veterinary fees vary widely and standardized data are limited, insurers have little choice but to assume greater uncertainty. That leads to higher insurance premiums. As a result, consumers may feel that the premiums are expensive, but the coverage is limited. Fewer people then purchase insurance, which means less data are collected. Without sufficient data, insurance products become less competitive, creating a vicious cycle. Why is Sweden different? Sweden is widely regarded as a global leader in pet insurance enrollment. The country has provided pet insurance for more than a century, building extensive data on breed-specific illnesses and average treatment costs. It also maintains a well-developed system for pet registration and veterinary medical records. Thanks to this wealth of data, insurance companies can estimate risks much more accurately. They know which breeds are more likely to develop certain illnesses and how much treatment typically costs. This enables insurers to design fairer premiums and more appropriate coverage. Consumers also find it easier to understand why premiums are set at certain levels, increasing their trust in the system. Sweden's experience shows that the success of pet insurance is not simply a matter of having a pet-friendly culture. It depends on building a system that collects and shares reliable data. In the end, the future of pet insurance depends not on more advertising, but on stronger data and greater trust.